What's up, everybody? Welcome to Self-Storage Income. Now, today we're going to talk about self-storage, where it's at, and the opportunities associated with it. We're going to look at its history and where we are at in the cycle and try to understand the big question. Are there still opportunities in self-storage? Because as you've seen, self-storage has changed, and it's changed in a big way. But before we dive into that, please like, subscribe, and share. That is the currency of YouTube. It appeases the YouTube gods, and it really helps me out. Thanks, guys. Okay, so self-storage, where it's at today. Has the ship sailed? Is it already too late? This question is an interesting one for me. First of all, self-storage has changed, and it's changed dramatically. And we've seen in the news, like the Wall Street Journal, talking about self-storage, its performance, and what's gone on. It seems like everybody's talking about self-storage today. Everybody wants in on the game, or everybody's doing it. This is a big difference from when I got in. When I got into storage, nobody was doing storage. We couldn't hardly even get banks to lend us money on storage. A lot of people thought that it was a fad. After 2008, a few things changed. But as you can see from the chart and the numbers, self-storage spending, as far as new development, had skyrocketed after the Great Recession. We kind of had a plateau first few years, and then after that, it hit record after record after record every single year. As opposed to a lot of assets in the Great Recession, they were at the end of a development cycle, meaning they had overdeveloped. We saw this in retail, hospitality, we saw this in housing. They were at the end of a development cycle. They had gone through an expansion, and now they were going through a contraction. Self-storage was opposite. It had not gone through an expansion, but the expansion started. Looking at history of self-storage, we are in the greatest expansion that self-storage has ever seen. Nothing compares to it. The amount of storage facilities being built, bought, and sold is staggering. So the question is, are we too late? Has the party ended? Has the music stopped? This is a really good question, and we're going to dive into this really deep. But we first got to talk about all the new inventory, what's happened, and why. Why did this change happen? Well, we know there's cycles. We have long-term, short-term cycles. We have the business cycles, and we have long-term debt cycles, right? This is primarily just talking about capital and where capital goes in the economy. So as certain assets perform, capital moves from asset class to asset class, bond market to stock market to real estate, and different assets within real estate. It's going where it can get yield and where that money will be protected. This causes the expansions. It causes the booms and the busts that we all see and we all know about. Understanding real estate cycles and business cycles is very, very important, and it is fueled in large part due to lending practices and lending standards. Basically, can I get money? So, will somebody give me money to invest in real estate? If a bank says it's not going to give you money, it's hard for that asset class to go through an expansion. So it is a very four-dimensional process that involves the overall market sentiment, the lender sentiment, access control, government, and entrepreneurs, investors. After 2008, self-storage performed better than any other REIT in all of the real estate asset classes. It had the lowest default rates. Now, there's a few reasons why. The main reason, I think, is actually very misunderstood, and a lot of people get this wrong, and it's one thing that you have to be very concerned about when looking at where we're in the cycle. A lot of people thought that their default rates were simply because occupancy remained high, and so their underlying revenue hadn't changed in self-storage. This is not true. Occupancy in self-storage can vary very easily because we have month-to-month leases, so we can give massive discounts. Right when the recession was happening, what we saw is occupancy dipped, but not like other real estate asset classes. And one of the reasons was there was movement, there was churn. So there was actually people that needed to rent because they were losing their home and they were moving around. But also, that's because the storage facility owners started slashing their move-in prices. They started slashing rent overall. So although occupancy remained high, revenues tanked. But storage, unlike the other real estate asset classes, wasn't overloaded in debt. The reason being is people wouldn't lend to storage facilities. They were scared of it. They didn't understand it. And so you had to put a lot of money down. Banks did not want to be risky on storage. So they weren't overburdened in heavy debt loads, and they could actually take more fluctuation in revenue. This created lower defaults. Another reason was they weren't at the end of the cycle, so there wasn't as much supply in the marketplace for self-storage. They didn't build them all over. It was really hard to get a construction loan on a storage facility prior to 2008. That meant that inventory was kept checked in the market. Those two things together created a very good circumstance for self-storage to survive the Great Recession. Now, that has changed dramatically. We are at the other end of a development cycle. Debt is much more freely given to storage. People are taking debt and they're loading up on it. They're building at the highest prices to build we've ever seen in a marketplace, and we're putting more inventory on the marketplace than we've ever seen. Does that mean that this cycle is over? No. And that's not what I'm saying. What I'm saying is we are at a different point in the cycle of self-storage, and we are more probably towards the top, right? That doesn't mean there's going to be a great contraction. Now, there will be, because prices always change and go down, but self-storage is hyper-local. So this is where it gets into the idea that is there still opportunity in self-storage? Has this train left? And the great thing that I love about self-storage is I actually think there's still more opportunity in self-storage than any other commercial real estate asset out there, because the vast majority, over 50%, is still owned by small mom and pop operators that you can buy stabilized facilities that are cash flowing, have reasonable debt on at very, very low rates, and have high margins so you can weather the storms as they come. Now, do I think that some markets are severely overbuilt and will have very large contractions? Yes, I do. There could be blood in the water for those areas which are going to attract a lot of sharks. The last time it happened, we gobbled up as many storage facilities as we could. That's part of it. It's part of the cycle, but it's a part you can avoid. We can actually look at starts. Where are they building facilities? How much square foot per capita is in a market? So we can look in localized markets and see where they are at in their cycle. Some parts of the regions of the United States have not gone through major development cycles. They're actually on the back end of it, even though nationwide, we are on the tail end of a development cycle in the self-storage asset class. There's lots of underserved markets that are owned by mom and pop. There's still areas to build that are underserved, even though that is getting very, very hard to find. There's way more risk embedded into the self-storage market today than I have ever seen. But with that said, I don't see that different in any other asset class. So if we're looking at an opportunity cost, it's not like I'm looking at other assets and saying there's just inherently less risk. Now, that's not true across everyone's. I think hotels, for example, and industrial space are probably very primed. Also, we look at things like apartment buildings, right? Those are inherently less risky, but self-storage, just like a lot of those asset classes, we're in the middle of an inflationary period that is propping up prices. And we're having massive cap rate compression, meaning the cost for the same thing is getting more. This is happening across the board. And with self-storage, there's more opportunity to get in the game and buy a self-storage facility due to the vast majority of mom and pop owners. This is changing and consolidating. When I got into the industry, 90% of the entire industry was mom and pop. That's not true anymore. It's more like 55% today. So the answer is no, I don't think it's past. But let's talk about the dangers. I mentioned that we're probably in the most vulnerable spot that self-storage has ever been. That is due to the end of this development cycle, the amount of new inventory coming onto the market, incredibly low interest rates, which has propped up a housing market, which self-storage is very, very tied to housing market and moves, new home startups, people moving around. More people moving mean occupancy rise, demand rise, and we can charge higher prices. I do worry that we could see a change in interest rates due to inflation, which would slow down the housing market and also make a lot of storage facilities that are coming on board at the highest cost to build that we've ever seen at a higher interest rate and struggling to fill up, and especially at the price that they need to, while a housing market is slowing down. This is the risk. This is what I see when I'm out there looking out at different marketplaces where we're developing, which we're developing a lot. We're acquiring a lot all over the United States. So how do we get over this risk, and what do? Look micro. So we can see new storage facilities being built. We can see pricing. We can see revenues, occupancy. We look within those 3-mile radiuses. Demand is everything. And as long as you're buying or building where demand is super, super high and you're doing it conservatively, you're not getting over your skis, then you should be fine. Look where there's high demand, but no new inventory coming in. That in itself will allow you to be successful no matter what. Demand caters with everything. Markets that are overbuilt or have lots of new inventory coming on board, you should be concerned about that. Make sure your debt is locked out as long as you can at these incredibly low interest rates. Make sure you have great management in place that when there's a contraction or a slowdown in the housing market, which affects self-storage, that you'll still be able to capture customers and high-paying tenants. Watch your downsides. With that said, I don't know that this will ever end. I don't know that there will be a contraction in housing. I don't know what's going to happen. And that's what it comes down to my most important point. The ship hasn't sailed, and I don't know that it ever will. The ship hasn't sailed on housing or any of the other asset classes. Even retail is still here. It just changed. I don't time markets. I just buy good deals. And good deals are good in bottom markets, in sideways markets, and top markets. And that comes from the fundamentals. And as long as you do that, absolutely not. The self-storage ship has not sailed, and it can still make you incredibly wealthy and a lot more free.